Now, let's look at real returns. I think that's important. So these are 25-year returns for a $1,000 investment. We're assuming that we're not. Well, it's not an assumption. CPI for that period of time was 2.29%. So even if you didn't have all of your money in being the TSX, let's say that you were a cautious investor that used a 50-50 split between being the TSX and 5-year GICs, you would have still beaten the index after CPI. So you'll see on the right there, the total return index, your $1,000 would have wound up as 4,133. If you had half in being the TSX and half in GICs, you've gotten 4,298, but with much less risk. All dividends and interest were reinvested. So we were talking about this little experiment where a guy or an individual did a 50-50 split between being the TSX and 5-year GICs. He would have still beaten the index. Next. Now, something that a lot of people talk about is, should we be more concerned about dividend yield or dividend growth? And I really think that was a question that was brought up simply by some investment folks that were trying to set up an ETF based on dividend growth. As far as I'm concerned, the dividend yield is much more important than dividend growth. I have here results of a little experiment I did looking at 45 S&P TS60 stocks plus some REITs, and you'll see that there's a very significant negative correlation there between the dividend growth and dividend yield. So the data average is that yellow button there, but where we are with being the TSX is much higher up on the yield curve, and REITs are pretty close to that. So I think focusing on yield rather than dividend growth. And this next slide, I think, will show that as well. This shows the importance of dividends in the S&P 500. From 1871 to 2009, the bar graph on the left, you see dividend, dividend yield is in blue, dividend growth is in red, and the price increase is in kind of a pale green there. So dividend yield was by far the most important. Between 1982 and the year 2000, there was this huge people investing in growth stocks. So price became more important, but still dividend yield was more important than dividend growth. Over the long term, dividends have accounted for some 90% of the total return, and dividend yield contributes much more to returns than dividend growth, maybe 6-to-1 ratio. Okay. Does the high dividend strategy mean no growth? People seem to think if you invest in stodgy old dividend stocks, it means you're going to have no growth. That is not the case at all. Here's another one of these graphs that show 10 years of the S&P. I'm sorry, the S&P TSX S&P index, and you'll see a huge difference. No new high for the blue line, a new high for the one with reinvested dividends. You'll see a huge difference there just in 10 years. So high dividend stocks outperform, and they also mean higher growth. I want to remind you that brokers want you to chase growth. They want you to trade a lot, and they want to generate commissions for themselves, and that's a mug's game, and you should avoid it. Now, the big thing about being the TSX is not these 10 stocks every year and how much we beat the index. The big thing about it is that a lot of times those stocks stay on from one year to the next, and you keep investing in them. Now, let's say that a stock drops off. We'll pick one. We'll say BCE, for example. You're holding BCE, and the stock isn't on the list for next year. And the reason is probably the price has gone up. that's not a good reason to get rid of it. If you like BCE and you think it's a good company, just keep that stock. And you wind up then, over a long period of time, building up a growing portfolio of blue chip dividend stocks, many of which have drip plans that you acquired at a reasonable cost. Keep in mind that long holding times allow these dividends to compound, and this is the real heart of being the TSX passive method. So the goal is not to buy 10 new stocks each year, but to wind up with a portfolio of these stocks, the reinvested dividends of which will see you through retirement. I've listed a couple of advantages of being the TSX system and also some disadvantages. You are in control with being the TSX system. You do the work yourself. It only takes maybe 10 minutes a year. You don't have to use a broker or a financial advisor. No mutual funds or management fees are involved. No time-consuming research. You don't have to pay for any research. Low risk, low stress, and most importantly, from my point of view, independence. Some disadvantages. Anybody that tells you about some kind of system, you should ask them if there's disadvantages. Well, there are disadvantages. If you're a person that likes to blame somebody for the problems you've gotten yourselves into, then don't pick this because you have no one to blame but yourself. A lot of people don't like that. They like that. They go, oh, you hear them talking. Oh, golly, if only my broker had done so or so, I'd be worth $1 million today. Well, I'm sorry, you won't have anybody like that to blame. Dividend cuts, tax code changes, we've already seen that. I've already seen that this year in being the TSX. And I can tell you, with the government's needing money so much, I wouldn't be at all surprised to see some tax code changes related to dividend stocks. And of course, the index itself. We can pick the stocks we want from the index, but we have no say in what goes into the index. And I'll bring a stock to your attention. It's called Laidlaw. It was in the index, it was in being the TSX in 1999, and it dropped 94% of its value. It should have never been there to begin with, but no one asked our opinion. Okay. I think it's a strategy for all seasons. An important advantage of this system is that it's well suited for both the accumulation phase and the withdrawal distribution phases of investing. It's a very versatile system. In the accumulation phase, dividends, you should reinvest those for compounding. But in the withdrawal phase, the dividends can supply income for you. The percentage of being the TSX stocks versus fixed income can be varied as you need. I view being the TSX as only part of a well-diversified investment portfolio. You see this graph here. Accumulation phase, you're kind of putting money in and investing and reinvesting those dividends. In the distribution phase, you're taking those out. This is not going to be the only part of your investment portfolio. You're going to have fixed income, growth, other parts as well. Here's a quote from Warren Buffett. The electric utility business is not a place to get rich, but it's a place to stay rich, which is to say that it's not a place to get rich quick, but it is a place to stay rich. So you've had a pretty good chance of making money and beating inflation by systems such as this. I've often found that it's easier to make money than to hold on to it. It's the dividends that help you hold on to it. And that's what we're trying to do with being the TSX. Now, of course, you're going to make some mistakes in your investing career. No one gets through without making mistakes. Some of them can be quite costly. My major mistakes have been mainly from trying to time the market, especially in shorting the market. I knew that these stocks were irrationally overpriced, but they continued to go up. John Maynard Keynes said, markets can remain irrational longer than you can remain solvent. He was absolutely right. Sometimes the market undergoes mass insanity, and when that happens, you better get out of the way because you'll be run over. Now, this next one shows you a little mistake that I made. Here's a copy of a check I got back from selling my Enron shares, and you'll see that I got 1 cent for that. Of course, I saw the warning signs in Enron, but I wanted to just a little more profit before I sold my shares. Greed and fear are the two biggest problems you run into, biggest enemies for individual investors. We don't have enough time for me to talk about all the other methods involved in terms of investing, but I do want to mention one, and that's technical analysis. So I have here 4 graphs of stock charts. 1, 2, 3, and 4. And they're all, I guess, 6-month charts. Do you want to risk your retirement on your ability to divine what's going to happen next for those 4? I don't think you want to do that. Do you want to pay someone who claims they can tell you what's going to happen next? I don't think you want to do that either. The point is, and I've made this before, the future is unknowable. No one can tell you what's going to happen to those 4 charts next. You don't know if they're going to go up, down, sideways. There is no limit to the human predisposition to detect patterns in random noise. I think it's mere illusion of validity. Here's being the TSX a practical example. I bought shares of Enbridge when it appears as being the TSX stock in 1995, first year that I did it. And I dripped all the dividends after that. So you'll see the price, the adjusted price, and the shares. Then jump up to 2010. You'll see the difference. Compound annual growth rate for me for the price was 12.6%. For the number of shares increased 3.5% per year on average. So the value increased by 16.5% overall. If I hadn't dripped that stock, it would be worth $67,408 as compared to the $112,426 it was worth in 2010. So I made $45,000 by dripping it. That doesn't count, of course. I mean, I did have to pay taxes on the dividends. Yes, I would have had to do that anyway. So buy and hold works, dripping works, and compounding makes a big difference. You don't need many 10-baggers to be a successful investor. Here's the portfolio for this year. A really unusual year. You'll see the little red crosses on the top right there. The top 3 stocks have cut their dividend. That's never happened before. The 6 with red stars on the left are repeats. So, of course, you're saving money in terms of reinvestment costs. And you've got 1, 2, 3, 4, 5, 6, 7 of them that have drift and SIP stocks. So we're a little bit behind the index as of right now. There's still time. The S&P TSX Composite has gone up about 10.9%. Being the TSX has gone up about 10.8%. I don't think anybody's going to squawk too much if we wind up making 10.8%. You'll see there's no REITs here. We talked about real estate. You're not going to get any REITs from TSX 60, so you have to go elsewhere. For example, TSX Composite. A person that I recommend that came to speak to our share club was Dennis Mitchell from Century. And you can see him on BNN, or you can go to the Century website. He usually knows what he's talking about in terms of drip stocks. Well, I wanted to, we talked about beta before, and we talked about how long these stocks have been around. This is the beta in the founding year for the portfolio for this year. You can take a look at those stocks. Most people will know those names. And you'll see the beta is low. If if the beta is 1, it's equal to the volatility of the index, and our beta is just a little bit over half. So that's pretty good. The year founded, average 116 years ago. So we're getting blue chip stocks. Being the TSX is an investing approach designed for safety using low beta, high yield blue chip stocks. I view it as a safe harbor for investors. Is there any safer investment you can get? Of course there is. You can invest in Canadian savings bonds if you want, Canadian government bonds. But you assume the risk of low negative returns after inflation and rising rates. So negative real returns, and that's not going to help you when you retire. Sadly, in our current economic reality, you're going to have to take on more risk if you expect to receive an acceptable return. I see this meeting the TSX strategy as the most palatable of the alternatives open to Canadian individual investors. I'm going to wind up now with just some thoughts on financial advisors. Here's some reasons to avoid financial advisors. I think the number one reason to avoid financial advisors is because of their inadequate appreciation of their own ability. And it leads them to take risks. They are convinced that they're the best stock pickers in the world. They're almost always overconfident about their ability to forecast the market and to pick good stocks. If you take the word of an overconfident advisor, you can expect costly consequences. They fail the test of persistent achievement. Their educated opinions are often no better than blind guesses. You have an agency problem. They're supposed to be an agent working for you, but are they really? You have to think about that. There's the illusion of validity. Like doctors that wear white coats and like lawyers that wear false wigs, they think they can do no wrong. And they're also quite guilty of short-term thinking. With these mutual funds, of course, it's every quarter. I have to turn a profit every quarter, or else people are going to sell my funds and go somewhere else. So no long-term thinking there. You might think then that I'm saying you should avoid financial advisors for good, but I'm not. I'm not. I think there are some really good reasons to use a financial advisor. You just have to make sure that they're right for you. They should be honest and independent. They should have a lot of skin in the game. Don't ask them what they think you should be buying. You ask them what they're buying for themselves. And they must have the courage to act. Often, they talk a pretty good game, but when it comes down to making decisions, hard decisions, it's difficult. And of course, they should have all the legal and professional prerequisites. Not just be mutual fund floggers, but actually be trained financial advisors. In my opinion, the best training for a financial advisor is accountancy and not an MBA. An MBA, I think, is just a marketing degree. Marketing is half what's wrong with the world today, in my opinion. What can they do for you? They're very good for financial and estate planning, taking the long view if you can get them to do that. Tax advice, hand-holding. Don't laugh at hand-holding. You start this off and you're going to be your own advisor and you're going to do all this stuff on your own, and all of a sudden the market drops 10%, things get a little hairy for you. These advisors, they've seen all this before. They can help you through some rough times. They can act as power of attorney. They can do a lot of things for you. Well, let me give you the conclusions. I think Canadians are getting fed up with financial advisors and mutual funds that rip them off for non-performance. You can empower yourself as an individual investor. That's what this is all about. Financial literacy. Knowledge is empowerment. Using the Canadian MoneySaver and share clubs. And I hope, I should have said this before, of course, but I hope you realize that I don't receive any money or get any remuneration for any of the stuff I do from MoneySaver. I do it because I think it's the right thing to do. Share clubs, I hope you have one in your geographic area. If not, you might want to think about starting one. They're really useful for people that would like to come and talk about their investment problems or what they're doing with their investments. Live simply, save more. Ignore both the prophets of apocalypse and the cheerleaders of rapture. Courage and patience are the most important attributes of successful individual investing.